Welcome back. As usual, let me give you the bottom line up front. A lot of investors that I hold in high regard are saying that this market is starting to look like a bubble. I'm going to break it down for you this quarter, but spoiler alert, when I'm done, you can count on me sounding like a broken record because your retirement formula hasn't changed. Save 10 to 15% of every paycheck, be aggressive when you're young, dial that back as you age, know that the market has returned 10% on average, and stay the course. It can be a bumpy ride. Work with your financial advisor on catch-up savings, your retirement date, taxes, healthcare, and estate planning. By and large, this is timeless wisdom, just like eating your veggies. Every once in a great while, something happens that requires more expertise. This quarter, that may be artificial intelligence. We've got plenty to talk about, and since AI is the main topic, I'm going to do something a little different and pass the baton to my alter ego this quarter, AI Vern, a very crude example of the changes in our near futures. Take it away, AI Vern.
Okay, great. Thanks. Let's start with the headline. It was a big quarter. Markets were up roughly 15%. That's a strong number by any measure, strong enough that the S&P 500 closed the quarter at 7,499, which is up about 110% from its October 2022 low. In other words, the index has more than doubled in under 4 years. Let's talk about why. Here's where we sit on the bigger picture, and it sets up exactly why this quarter's rally has a name attached to it: SpaceX and AI more broadly. The SpaceX IPO was the headline event of the quarter, and it's really a stand-in for a much bigger story. Anthropic, OpenAI, and others are lined up right behind it. Trillions of dollars of capital are being committed to data centers, LLMs, energy, the whole AI build-out. That's been the fuel behind this rally. But it raises an obvious question. What about valuations? Let's take a listen to this.
What's going to happen in 5 years that you're seeing that maybe a lot of people aren't seeing that's going to blow people's minds?
So 5 years being, say, 2031, digital intelligence will exceed the sum of all human intelligence. That there will be, in 5 years, let's say at least 100 million humanoid robots, but maybe a billion. Yeah. I would predict that the economy is probably twice its current size in 5, maybe 6 years. 5 to 7 years, because you're going to hit a doubling period. Where the economic output is increasing so fast that plus minus a few years, you will see giant changes.
Here's why I think this is really the hinge point for the bull case in the market right now. If the economy, GDP, can grow by a multiple of what it is today on the back of what Elon's describing, history is going to look back at this exact point in time as one of the better opportunities to put capital to work. Investors who stay in will be very well rewarded. That's the bet the bulls are making. Here's where that capital is actually showing up. 5 industry groups, hyperscalers, semiconductors, hardware, power, and software, have driven the bulk of this rally, and together they now make up over half the S&P 500's total weight, 51.5% to be exact. Semiconductors alone are up 98% cumulatively since 2023. And it's not just price. The right-hand side of this chart shows earnings growth running right alongside it, with semiconductor earnings up 103% year over year. So far, the spending and the earnings are moving together. That's the bull case in one chart. But here's the flag I want to raise, and it's the central question mark for this whole rally. Look at this. Hyperscaler CapEx has gone from $71 billion in 2019 to $416 billion last year, and it's projected to hit nearly $1 trillion by 2028. That's about 14 times where it was just 9 years ago. This is a build it and they will come strategy, and the question worth sitting with is, what exactly are we building? What new tools and services are we all going to benefit from and be willing to pay for that don't fully exist yet? How are our lives actually going to be better? That's the real challenge in investing in today's market. You have to be able to envision a future that doesn't exist today. It's also straining the hyperscalers' own books. Free cash flow has been squeezed to the low single digits of sales as CapEx ramps. But CapEx doesn't run forever. When it stops, the payoff has to show up as earnings, the E in that P/E ratio. If it doesn't, that's the unknown that matters most right now. Now let's switch to the bear case for the markets and recall what I said at the start of the video. It can be a bumpy ride. The business cycle isn't dead. We'll always have economic expansions and contractions, and it's typical for there to be some overbuild during the expansion phase. We as investors have a tendency to get overexcited. And when that shows up as too much capital chasing too few good ideas, it can naturally set up a recession. That's the volatility that has always been the price of admission for returns. The forward PE ratio on the S&P 500 is 20.4 times versus a 30-year average of 17.2 times. That's roughly one standard deviation above the long-run average. The CAPE ratio, Shiller's version, tells a similar story, 40.7 today against a 28.8 historical average. Elevated, clearly. Whether it's outrageous depends on that earnings question. I'm going to share with you a historical market indicator that was preferred by Warren Buffett. He liked to look at the total size of the economy, GDP, relative to the stock market. As of 2025, the total market cap of US stocks is $67 trillion against GDP of $30 trillion, a gap wider than at any point on this chart going back to 1947. Take a look at this video that shows the historical relationship between GDP and the market. And at the same time, here is famed investor Jeremy Grantham talking about just how out of whack that has gotten.
In a very real sense, I'm not sure there is a comparable, but the tech bubble of 2000 would come the closest. On the ways that are the value systems that are most predictive, based on the value of the stock market compared to the GDP with modifications. This is the most expensive market in American history.
Long-time listeners will recognize this chart. It's one of my favorites, and I try to share it at least annually because it gives some perspective when trying to ride out market storms. Here's what you're looking at. The range of annual returns for stocks, bonds, and a 60-40 blend. Over any single year, stocks have ranged from as low as minus 37% to as high as plus 52%. But stretch that out to a rolling 5-year window and the range narrows to minus 2% to plus 29%. Over 10 years, minus 1% to plus 20%. And over any rolling 20-year period, stocks have never lost money. The range is plus 6% to plus 18%. Stocks have averaged 11.7% a year over that stretch, turning $100,000 into just under $909,000 over 20 years, versus about $278,000 for bonds. Time in the market is what turns volatility into return. Lastly, I want to leave you with a little short-form video that tells the same story in a slightly different way. What you're watching is the likelihood that you'll lose money as an investor. At month 1, that probability is north of 35%. By month 106, it's down to just 2%. I thought that was worth a look. So, as always, let me leave you with some perspective. Don't ignore market valuations, but be mindful of where you are in your own investor life cycle. If you're at or near retirement, take these valuation levels a little more seriously and lean toward the bottom end of the risk range you set with your financial planner. If you're younger in your investing life cycle, you can take all of this in stride. The picture painted by the AI build-out is real. The tools are real. The productivity gains are real. It might well be a bumpy ride, but it does mean markets are likely to deliver a long-term acceptable rate of return. You just need the horizon and the stomach to tolerate the volatility. AI is a real opportunity, and it will also bring growing pains. So be patient. Thank you for your time and for tuning in. Please send your questions my way. We're here to simplify your financial future. Thank you, and I'll see you in the next update.